Hello, hello, everybody. Welcome into the webinar here. We're just getting rolling. Got a few people coming in. Actually, a lot of people coming in.
Yeah,
It's been a good turnout today. We're really excited to share. So this is live in person. We're here in Kansas City, and a lot of you guys know who I am from the podcast and just from being an Aspen for a long time. But really excited to do this as a joint webinar with Ellis Hammond. A lot of you may know him from other things, but he just recently joined our team really just a few weeks ago, and he is taking the role of Vice President of Capital and really going to help take the leadership of our capital team to the next level. And so really excited to have him on. You're going to be seeing him a lot more on these webinars, on different things that we're doing, talking about the deals that we're doing. So my role is still Chief Investment Officer. I'm going to retain that role for a long time, and Ellis is really coming on to help support the capital growth. So we're going to do this webinar jointly. It's going to be a little bit different than maybe some webinars. I have some slides that I'll go through, but this is really an update to our Aspen Private Credit Fund, which we'll talk about. It's just been rocking and rolling this year. Really excited about the growth of the fund, the assets that we're putting into the fund, and sometimes it's hard to get granular with what am I actually investing in? I'm investing into a fund, right? But it kind of becomes a black box. I don't know what's inside there. And so we wanted to take some time and actually go through the next deal we're planning on closing here in a few weeks. It's a really, really exciting addition to the portfolio. So really want to talk about it, talk about what it means, how it fits into the broader perspective of the portfolio, and do some Q&A at the end. So Ellis.
Yeah. I'm fun to be here. It's my first webinar. Hey, everybody. Hey, show us some love in the chat. If you're at your computer or whatever, just type here. We can see your responses. We have you pulled up on the screen. So just let us know where you're zooming in from. I'm curious, is anyone in or near the Ozarks? So that's what we're talking about today. We do have a new deal. For those who are asking, I've talked to a lot of folks. Hello, Daniel from Portland, Benjamin from Brooklyn, New York, Danny from Houston. Hey, everybody. Great to see you all. Chico, nice to meet you. I spent the last 10 years in San Diego, California. I had a quick stint in Phoenix, and now my family and I'm married and have 2 young kids. We just moved to Kansas City, so we're grateful to be here. So another Overland Park. Who's that, David?
Hey, David.
Hey, David. Great to see you. Come see us, man. We're right here in the office. You actually could like come right now and be in the video. But so I've talked to a lot of you, and especially those of you who are wondering, what we're going to be talking about here today. This is for the Aspen Private Credit Fund, which is an open-ended fund, as many of you know. And we wanted to give you a glimpse again of what the type of deals we're putting into this fund so that you can see. Because again, your capital. So if you're currently in the fund, some of you have asked, do I get access to this deal? And the answer to that is
yes.
Yes. And if you're a new investor, you get access to this deal and how many deals?
6 other deals that we've already closed.
And so 6 other deals that are already closed, already cash flowing.
Yep.
We sent a distribution out just a couple days ago. If you're here and you got your distribution 3 days ago, put in the chat me so we can see, because we did. We just sent out a distribution a couple days ago. And then we sent out a quarterly profit distribution just last month, which was about what?
An additional 4.6%.
Yeah, 4.6%. So this fund right now is averaging over 10% cash yield to investors. So let's talk about Lake of the Ozarks and get into this. So before this fund, what I knew about Lake of the Ozarks from San Diego was the show Ozark. Is that bad to say? Marty Bird. Any Marty Bird fans in the audience? Any Marty Bird fans? So Ben, let's walk through Lake of the Ozarks. What was the appeal of this deal in particular?
Yeah, well, it's funny you say that because it's actually part of the growth story of this area. I mean, you can imagine, right? It's the show is kind of mixed on its perspective of the Ozarks, but nonetheless, it is blown up the exposure to a huge audience that now know about it, right? I mean, you guys know of the Lake of the Ozarks, and it's a pretty cool lake. So here we're in Kansas City. If you're in Kansas City and you want to get to the water, beaches are very, very far if you're going to the ocean. This is the closest kind of place you want to go if you want to go get on a boat, go have some great lake time. It's one of the largest man-made lakes in the country. I grew up going there a lot, so it's something that's close to home. And one of the things we like with this fund is, when we're looking at adding assets to the portfolio, our goal is not to go what's called loan to own, right? We don't want to go be aggressive and try and take over a deal just to take it over. But one of the key things we're looking at is this something that we understand, that we know we can manage if we had to take it back as, take it back the collateral? And the answer on this is absolutely yes. It's kind of right in our wheelhouse, both from a location, but also what we know what to do. So Ozarks, I mean, it's a really cool area, especially in the Midwest. You don't have a beach. Like I said, largest man-made lake, and it's I think 95 miles of lakefront. So just a huge lake. And the deal in particular, we can get into the stats. I like the area, but you really have to get granular to the deal. What is exciting about this deal? And there's a lot of things about this that make me really excited, especially as a senior lender on this loan.
So let's pull up. You have a couple slides you want to pull up, because I want to walk through. I think it's important for people to see the details of the loan, because again, you're investing into the fund, and the fund essentially is providing working capital to real estate sponsors and real estate deals across the country. And so I think it's important for you guys to see just, again, how we're structuring those loans, and why, again, I mean, as a multifamily investor myself, I am incredibly bullish on the Aspen Private Credit Fund, because, you think about it, like investors ask me, well, why this one? I mean, you're getting the opportunity. I mean, this is essentially a new development deal, but in a lot of ways, we're investing in 2024. A lot of people started investing in multifamily and real estate back in 2020, 2021, 2022. We get the chance to kind of come in post all that just happened, COVID, interest rate, and essentially get to pick our terms. I mean, I think that's incredibly attractive for investors. And so let's talk about this one in particular.
Yeah, absolutely. And just a couple of little things here. You can see the picture on the right, the map of Missouri. So it's actually pretty much smack dab in between Kansas City and St. Louis, or as one of our good friends likes to say, on the east coast of Missouri. We're on the west coast. And so it attracts people from all over, both sides of Missouri, and also from down south, which is Arkansas. There's some other great lakes down there, but there's a lot of people in kind of the other Missouri markets that go there. So kind of right smack dab in the middle, so it pulls from a lot of different areas. I actually misquoted. I said 95 miles of shoreline. It's 1,300 miles of shoreline.
Wow.
So a very, very large lake. But from a deal standpoint, this is a first lien. So we are the senior lender, and we have a very low loan-to-value ratio of 42%. So that means we're putting out, it's $5.7 million, but the value of the collateral as a recent appraisal, is $12.8 million. So if we had to liquidate right now, we would have $12.8 million of hard collateral that we have a lien position on that secures our $5.7 million loan.
That's incredible.
Yeah. So it's, a lot of security. My background, a lot of you know, is as a banker, was a commercial lender and underwriter for a long time. And these are the kind of things that, if you're speaking a banker's language, LTV is a big one because it's not the only measure of risk, but it becomes the biggest margin of safety, right? If you want to understand what kind of risk do we have with the capital out in the fund, that's one of the key metrics you're looking at. But here's the other cool thing too. We're not a bank, and this is kind of in a unique spot. I'll talk about the story of why they're willing to take the terms that we're offering them. Is they're kind of in this no man's land area, right? So when you're buying land, this is land to be developed, and you have a few options. You can go get a bank loan for the purchase of the land, but a lot of the horizontal improvements, right, to make it ready to go vertical and actually build the buildings, that's hard to finance with traditional banks, especially if you're not a huge borrower and some kind of national developer. It's very difficult to get decent leverage. So they've actually, this particular parcel of land, it's got 138 lots. It's been in the family of this family that we're lending to since 1998. And they've kind of been progressively moving it down the field ever since then. And so they've put $11 million of their own cash into this project. To get it to the point where now it is almost 100% shovel ready. So of the 138, I believe it's 126 of the lots that have been individually parceled are ready to be developed. So
already through entitlement,
fully entitled, permit ready. Like it's literally shovel ready.
Which,
So,
I mean, going back to the collateral, if we do have to
Yes.
take this over and liquidate this portfolio, I mean, the fact that someone can now take over entitled land,
Yeah.
that's a massive deal. We're not taking the entitlement risk, because that can be a risky procedure. And then we're also out of this deal before development as well.
100%. Yeah. So our takeout, and this is kind of where we come in, because they have a current lender that kind of got them to this point. But now the current lender is not really playing ball, and they're saying we're not going to do partial releases, right? If you understand what a partial release is, it's effectively I sell off a parcel of land and I want to reduce by the same percentage that I'm in at day one from an LTV standpoint my loan, right? So if I sell a parcel of land that's worth $1 million, I'm at a 50% loan to value, they would reduce the loan by $500,000 in that scenario. In this case, the current lender is saying, you got to pay us fully off. But the problem is when you're selling these lots, you're selling them in batches, usually, a couple at a time to sometimes a dozen or more, and you're not going to generate enough cash to pay off the whole entire loan.
Right.
And so they're kind of in a pickle.
The essentially what I'm hearing you saying is if they sell one or two, it triggers the loan to pay they're saying, hey, the bank says, well, we want it all. Exactly. And they're like, well, we don't have it all. Right? They're a little bit
for them to sell it, the bank has to release their lien.
Right.
And the bank is not going to release. It's not a bank. It's another private equity lender. They're not going to release the lien until they pay the whole thing off, and they can't pay the whole thing off. So they're kind of a chicken and egg. Yeah. They're kind of forcing their hands.
So we're replacing that. We're going to be more flexible.
Yeah, and we're giving them what they want, which is something that's totally reasonable.
I mean, because these terms are, like, let's be honest. I mean, these aren't that friendly. I mean, 16% all in, and they're paying 8% current, 8% accrual. That means
plus 3% up.
Explain what that means. 8% current, 8% accrual.
So they have to pay us every month 8% of the 16%. It's called current pay, and then that 8% is also accruing annually on the back end, added to their loan balance as they pay us.
And then the 3% origination fee is essentially what we take once we give them the money.
Yep. Once we close,
like a signing fee.
Yep. Exactly.
Awesome.
Yeah. So it's pretty expensive money, but you got to think about from their perspective, they've spent now over 20 years at different stages getting to this point. They've put $11 million into this. Right. Their current lender's not playing ball. They don't really have any other options. We've come in and we're going to be in the same lien position. We're paying them off. We're going to get them the small amount of working capital that they need to kind of get it over the finish line. Yep. And then start selling it off to developers and get the ball rolling. And if you look at what's going on, which I'll get into here in a minute, of just some of the stats that are happening in this area from a tourism standpoint, from just development standpoint, it's a big deal. So the timing is really, really right. And we're willing to structure it in a way that helps them. Because here's the thing too, the partial release is kind of a double-edged sword. Because in this case, they have 138 lots, right? So it could potentially be an operational challenge of just, can you actually manage the partial releases? But we're well staffed. We've done this on other types of projects like this, so we can actually support the needs of the borrower. And because of that, we can charge pretty high rates and kind of get the best of both worlds here.
That's great.
So I kind of talked about this a little bit. I think I said all this, but you can get a picture here on the right. This is the Big Island. So they basically bought this island. I think they bought it for $1.5 million as raw land in 1998. And they've sold off different lots at different points. So they don't own all these lots, but the majority of these they do. And you kind of see here on the kind of top side of it, the Big Island West View. This is most of what our collateral is, and these are the prime locations. So they've kind of held the prime location for now. This is all the shoreline, right? So these are going to go at a premium. They also have, it's very difficult to get in the lottery system to build docks, because the interesting thing about this lake is they actually allow individual docks for each boat owner or lot owner, where a lot of big lakes, you have to kind of go into a larger dock where you get a partial slip or whatever. But they have a lot of these slips that they got way back in the day that they can allocate to these different lots. So they got prime location. There's a lot of development happening. It's a great part of the lake and ready to go. So like I said, these borrowers, they got a lot of skin in the game. $11 million into this project. It's been in the family for a very long time. And one of the things we look at too when we're underwriting a loan is not only the collateral that we have, but also the sponsors behind the deal. And they have very strong balance sheets to support this project, meaning they have high net worth, strong liquidity, and they've also got significant development experience, kind of in not only this project, but a lot of other projects, getting this kind of to shovel ready and beyond.
Yeah. So, so there's a couple, someone asked about why would they not just go to a traditional bank? We answer that because the reality is they did, or they were with another lender, but
it wasn't even a bank. It was another private equity lender.
Okay.
Yeah. So let me go back to that thought. Thanks for reminding me. And put more questions in the chat here. This is a little bit more informal. We'll kind of go back and forth, but they're in no man's land from a bank standpoint, right? Because you can buy the raw land, but the bank doesn't want to put a lot of money into the entitlements because there's a lot of risk in entitlements, right? It might not happen. You might not get it entitled, and now the bank has put money out that they can't get recouped on because the value's not there.
Right.
But now they're in this weird spot to where the bank still doesn't want to lend because they want to see the next stage of it. They want to see the construction. So what we're coming in is filling this gap. Hence the bridge loan idea of this. We're bridging them to the takeout, which will be construction. So they'll sell off batches of lots to other developers. They'll also be developing some themselves. So when they, in both the scenarios, they'll sell some lots. Those lots will be purchased through a combination of equity and debt of the new developer, their lender, to go actually build vertically and actually build these nice residences. And then the ones that they develop themselves, they will also pay us off through a new lender that's ready to do construction financing, right? So there's different types of banks that like different things, and construction financing is a very, very well-developed segment for most banks that do that. And so they'll have no problem now that these lots are ready to go, but to kind of go take the whole project down in this stage, that's where funds like ours really come in and are able to command really great yields for pretty low risk. And hence the whole reason we love the space of private credit, debt investing. There's just a big disconnect, a big dislocation between the capital need for a lot of these types of deals and what's actually available in the market. We could spend the whole time on that, but banks are consolidating.
As an investor, I mean, we've definitely answered the question, in terms of collateral, what am I protected by? But another question I know a lot of investors ask, I ask as an investor, is how do I get out of this, right? And so you mentioned the construction, but just dive into that a little bit of just why you trust that we'll be able to get out of this loan whenever they go to the next stage of that, kind of what our security is for that when investors think, well, how do, again, you're not going to necessarily, you're in a fund, so there's a benefit to the diversification of that. But as the lender, you're asking the question, how do we get out of this eventually?
Yeah.
Talk about that a little bit more.
Well, it's great. One of the things is when you're charging someone 16% interest,
they're in a hurry.
you have a built-in reason for them to want to get out of the deal, right? So that's part of the reason why you can command these high rates is you're wanting to incentivize them to pay you off. Mm-hmm. And the great thing is it's going to be in batches, and so we're going to reduce the risk of the capital at risk over time as they sell these off. Now we do have a couple year maturity, so we put this out where it's going to be, we're not expected to get paid off for a couple of years, but at that point, if we have say a maturity default, which means they haven't fully paid us off in that time frame, we can do one of a few things. One, we can extend, right? If we think they got a good plan going forward and they can get that next phase sold off. But we're going to charge them for it again. Or we hit the foreclose button. We are a secured lender in this deal where there's no one in front of us. We control the collateral. And they're not going to want to do that, obviously, right? $11 million of cash in the game. This has been a family project. This is very important to them.
Right.
They're not going to let that happen. And so we kind of hold all the cards here. And confidence level is very, very high. Now, can they sell off 138 lots in 2 years? That's probably a little aggressive, but it's again, as long as it's progressing that way, we're gonna have a lot of options, and if we're seeing that movement, they'll be more willing to work with them down the road. At the end of the day, ultimately, we have collateral as right now, fully entitled, shovel ready. We could go sell this off to one big developer, right? And we get fully paid off at a very, very low leverage rate. So obviously, the business plan is structured as we have it, but at the end of the day, our collateral is very, very strong in this deal.
Do you want to talk about what the actual project is? Do you have more slides on that, or is there anything you want to speak more intentionally about or specifically about?
Yeah, I mean, we can get into it. It's a little bit, little bit dry, so to speak, of all the different lots and different things. But there's different types of lots we're doing. Some duplex. We have the waterfront lots. They're selling them off in batches, like I said, and most of them are shovel ready. And actually, misspoke. I said 200 dock slip permits. They have 300 dock slip permits that secured over 2 decades ago, which are very, very difficult to get right now. It's basically a lottery system. So that, again, it's not even included in the collateral because it's hard to value from an appraisal standpoint. Right. But when you have those dock slip permits, if someone's looking at, I want to build here versus here, and here I don't know if I'm going to get a dock slip, but here I know I will get one. If you're a boat owner, if you like the lake, you grew up on the lake. Yeah. You want that dock slip.
Definitely, definitely. Someone's asked, will this deck be placed in the data room? Yeah, we'll get. We do not have these slides in there yet, but we'll get an updated deck. Someone also asked what other deals are in this fund. There is in the data room a current project list. We'll get that updated as well. But you should have a deck, and if you don't see that, need that immediately, just email us. But we'll get the data room updated so that you have all current projects and these slides as well.
Yeah, and just as a reminder for those that are new to the fund or haven't seen all the full presentation, we do every quarter, me personally, goes through every single deal that we added to the portfolio and gives an individual advised video, talk about the stats, talk about exactly how we underwrote it, talk about what we're earning at a gross level for the fund and why we love the deal. And that's all very, very clear. You can see it for every single asset. So we have all those videos individualized in the data room. Yep. And we'll do one for this deal as well once we close.
Yeah, you actually walk through each deal. That's great. I'd show my data room right now, but we're having a
yeah, it's not working. Well, let me talk a little bit about Lake of the Ozarks again. So I mentioned I have some stats here. So obviously, you want to see population growth as a big driver because more population growth increases demand for exactly what these guys are building. So we've seen pretty strong population growth. It was nearly just under 8% in the latest census. And then regional growth, we've seen the whole region grow by 8% with over 42,000 residences. This one's kind of nutty here, and this is tying back to the Netflix
Marty Bird
series. Tourism, right? So historically, Lake Ozarks attracted 5.4 million visitors annually. Some people hear the Midwest like there's people actually live there. Hey, it's great over here, but it
is, by the way. I'm 2 weeks in. You guys should consider, my California Chico. Whoever's there from Chico, get the heck out of Chico. Consider Kansas City. Okay, keep going.
Hey, we love it. Yeah, so 5.4 million visitors. This is a pretty serious tourism area. Check this out. In 2020, the number surged to over $10 million following COVID-19. Everyone wanted to get out of Dodge, and also the media exposure. So this has got a lot of people's radars. And you can see here I got some drawings. This is actually in progress. It's a $400 million development for a brand new theme park that they're building down there. I mean, this is a place you want to be. You want to be hanging out. I'm going to take my kids down there once it's done.
Yeah, we'll see. Okay, I'm gonna oh, that was Wes. Hey, Wes, that's funny. He said we stopped investing in California. Any other questions about this? I want to emphasize, here's what I love about this. I want to make sure those who are just joining, welcome everybody if you're just in. We're talking about this number seven? Number seven deal that we're adding to the Aspen Private Credit Fund, which is available right now for you to be in. We're already doing distributions for this fund. It pays out monthly, pays a monthly dividend, and then quarterly profit sharing. And so this fund right now is yielding over 10% to current investors.
It's almost 12% right now.
Almost 12%. Yeah. So as a cash yield, you also have the option, which I think this is one of the rare funds that does this. You also have the option to reinvest all of those distributions in compound, meaning every time you reinvest, those dividends that are owed to you actually buy more shares for you. So you're able to compound and grow your investment backed by hard assets like this one, which I think is really, really great. And here's what I want to emphasize. We just went over the strength of Lake of the Ozarks, which, I come from the world of common equity where we were raising common equity, or I was a common equity investor, and we're maybe talking about one deal. And then population growth is really important, right? And but here's what I'll emphasize, guys, we are the bank. Like right. That is really important. But I also just want to say, it's not it's not as if we're relying on Lake of the Ozarks to all of a sudden become the next Disneyland, right? Right? Is because we are the bank. We're lending money. Now, are they more worried about it? Sure, but I think it's a completely different ballgame. And so if you were someone who invested in 2020 or 2021 or 2022 into multifamily or into self-storage or mobile home parks, and you were, trying to earn a blended 15, 20, 21% IRR, I mean, that was typically what folks were being offered. You now have the opportunity to start earning a 12% yield on your money today, right? We're paying that, and that's not even compounding today into really strong assets, right? I mean, I think it's a completely different type of investment. I think for those who are maybe new to this and they're thinking, well, why would I do this? What's different about this? I think the risk, the appetite, the risk level for this is way down, and your returns sure are a little bit cut, but not by that much. No. And most of those deals you're probably in 2020, 21, 22, you're not getting 15 or 20% anymore.
You hope to get back your capital.
You hope to get back your capital. Yeah. Right. And so I think this is a really, really great risk adjusted return to be able to enter back into. This isn't a multifamily deal, although we do have other multifamily properties in this fund. This is, of course, not multifamily. But my point is, it is a great way to enter back into the commercial real estate market in 2024 and into 2025 because of the returns, the risk adjusted returns, the level of risk, or really the level of risk we're not taking, comparatively speaking, over the last couple of years. So it's a really, really great opportunity.
I think it's an excellent point. I think a lot of investors, it's really important when you're investing that you use I like to think of a pie chart, right? A lot of people have seen a pie chart of here's my slice for stock, here's my slice for bonds, for commodities. But you also need to have a pie chart for all your private investments, all your real estate investments, right? And you don't want to be all in one asset class like multifamily. That's what most people think is, I'm going to invest in different asset classes. Yes, do that. We got some good industrial, we got some oil and gas, some other things. But you also got to think about where am I investing in the capital stack, right? And we talk about that a lot, is what is the actual risk that I'm taking in each of those deals? Yep. And what most people invested in the past few years. And the past few years also coincided with probably, I would say, the biggest surge of capital coming into the private markets that we've seen over the past decade plus. So a lot of new people invest in these things and seeing returns quoted at target return of 18% IRR, which kind of became the norm. That's not guaranteed, number one. Number two, if you actually look at the underwriting of most of those deals, that's pretty much all on the back end that you hope to get when your cap rate compresses and you actually exit. And so to me, it's not to say those are bad, right? I have a lot of equity investments. I like investing in equity investments because you get some of the upside, but you also want to have, I would say, a significant portion of your portfolio into lower risk, cash flow focused investments, right? Yeah. Because cash flow is the single best way to reduce your risk. If you're getting paid every month, then that is going to reduce your capital at risk. If you're waiting for all your return to come on the back end when you sell a property or a fund, you're really beholden to what the market's saying or doing at that point, and you can't control that.
Yeah. I think it's a great educational point for, really any alternative investors, but especially for those maybe who are just starting an alternative investment, is you can say, I'm diversified across multiple assets. Maybe I'm in self-storage and multifamily. But what you're saying is there's another level of diversification, and it's diversification in the capital stack. Because you're right, the higher you go, it's the more promised higher returns you get, but definitely not guaranteed. Yeah. Where the lower you go, your returns are ticked down a little bit, but the guarantee is higher, right? The likeliness goes up. And so I love what you're saying here. I think it's such an important point of emphasis as an alternative investor, if you're watching this, is thinking about your portfolio, not just in terms of asset classes, but thinking about your portfolio in terms of where you're at in the capital stack. And this is a great opportunity to go lower. You can see from this what I mean by lower. Higher is common equity, meaning you're the last to get paid, right? And in what we're offering, we're either going to be in the preferred equity standpoint, the mezzanine, and in this case, we're actually the senior lender, meaning we're the first person to get paid. So I think it's an excellent point.
Yeah.
That you're saying.
One thing I think that I always tell people when they're looking at comparing two deals, right? You have to adjust everything by the risk that you're taking, right? You've probably heard the term risk-adjusted returns, right? This is actually a mathematical concept, and you can calculate it. What's called a Sharpe ratio, but you actually can adjust the returns that you're earning for the risk that you're taking, right? And the natural concept is you want to be earning a higher rate of return for higher levels of risk to compensate you for taking that risk. But sometimes it's not always evenly spread out. So you can be taking actually inordinate levels of risk in certain deals, but actually not be getting paid that much more. Like, so maybe they're targeting a 15 or 17 IRR, but you're the last person to get paid. In our situation, you see this deal, we're getting 16% of interest is being charged to the deal. That's a guaranteed return for us, or for the fund. And we're the first one to get paid, and we're covered by over 50% equity, right? So they would have to lose all their equity before we would lose a dime. And so the idea is if you risk adjust that, we're earning 16% in arguably a substantially less risky position than say something in equity. So not to say it's you do one or the other, but blend it out. And I would say depending where you're at in your wealth building years, in your income earning years, as you go later down the road, you want to be shifting more of your portfolio to lower risk, cash flow focused investments, because again, that is
You say that though, as a guy that's probably more earlier in that journey, I would say I wish I'd have just done this, or I mean, think about this: 11 to 14% compounded returns over a 20 to 30 year period. Like that, in my opinion, is. I mean, we have other great stuff, so I don't want to say this is the only thing you invest in. But my point is that, yes, you're right. The older you are, maybe the more seasoned you are in your journey, you're going to move to more stuff like this because you're ready to take less risk. And understand when you're younger, you have an appetite. But I would also say, don't underestimate the power of compounding growth, especially at 11 to 14%. I mean, that's significant.
100%. I mean, I always go back to, I overuse this, if you heard me say it, sorry, but Warren Buffett, he has 2 rules for investing. Right? Warren Buffett's a pretty smart guy, been pretty successful at investing.
Yeah.
He has 2 rules. They're pretty simple. One is don't lose money.
Don't lose money. Yeah.
And number 2, you remember what it is?
It's probably the same one. Yeah, don't lose money again.
He says that don't forget rule number 1.
Yeah, exactly.
Right? And the point is, if you look at, how difficult it is from a wealth building kind of curve, when you lose capital, you lose money, it is a huge impediment, a huge challenge. So not to say don't take those risks, but make sure you're only taking the risks that make sense to take, and then do a larger portion of your portfolio into things that are not going to be taking those.
So a couple questions here I just want to go over, and guys, please continue to ask your questions. These are great questions. Let me just go over a couple of the key benefits to answer some of these things in here. So in terms of returns, so preferred distributions start 90 days after funding and are paid monthly. There are a few incentives because we're trying to close this deal before the end of the month. We are offering incentives to investors who can act quickly. And so if you're interested in that, we do ask you submit a soft commitment. We'll be in touch. You can schedule a call with our team. But there are some options for investors who can act in the month of November. And so if you are someone who has liquidity and you're looking to deploy and you can deploy immediately, I would say it would behoove you now to submit a soft commitment and schedule a call with our team so we can go over what those incentives are for you. But there are some great things we're going to offer for folks who can fund in November. But again, at any other point outside of the month of November, typically preferred distributions start 90 days after funding, and theirs are paid monthly. Quarterly profit shares offer additional upside, so we pay quarterly profit shares. That's a 70-30 split, meaning 70% goes to the LPs or back to the fund for distributions, and the manager, the general partner, in this case Aspen Funds, is a 30% owner of those profits. You also have the ability to choose to automatically reinvest, compounding your returns over time, and you can change that right at any point. Meaning if you want to start receiving distributions, you can, or if you want to roll those back into the fund, you're able to do that.
Yeah, it's kind of a cool thing. If you don't need the cash flow right now, you want to just reinvest that back into the fund. We have a quarterly net asset value calculation, so we reprice the shares every quarter based on the profitability, and you can basically go and buy more shares and earn that rate of return on a compounding amount of shares. So it's actually it will increase your overall return over time, right? With true compounding, which we allow in the fund. Yeah, it's a great point. Saw some other questions. So how long is the principal locked up for? Great question. So we have a 2-year initial lockup period, and then we have a 90-day liquidity request from there. So if you need your funds back after that, we ask for 90 days to get those funds out. So again, you get some nice yield, and you also have some liquidity after a kind of 2-year lockup.
Yeah, it's great. Like a lot of folks are saying, hey, I'm looking to be in something that's somewhat low risk. Especially if you're approaching retirement in the next several years. This is something where you don't need the cash flow now, but you'd like for it later. I think this is a great option to invest now, compound your returns, and then all you have to do is just give us a call or shoot us an email, when you're ready for more yield, and we flip that to distributions. And at that point, you also have the liquidity option because it's only a 2-year lockup period. So I know I've talked to a lot of investors where I think this is a great fit for those approaching retirement. Again, you're looking to take some chips off the table. You want to compound the money. You'd also like some distributions at that point. This is a great opportunity for that.
Yeah, absolutely.
I'll post one of those questions again, Sam. I thought those were, I'm just going to see some of these questions. So is there a town nearby? What county is this? What is
I don't remember the name of the county, but there's Ozarks City, and then there's kind of several cities that comprise the Lake of the Ozarks region. Because as I said, it's a huge lake, right? 1,300 miles of shoreline. But there's a lot of cities that kind of support that. I would say it's a hybrid of a lot of people that live there as a primary location than a lot of second home. So It's definitely more active during the kind of summer, fall, spring months. But there's a very strong kind of just base level of residential people live there as well.
Great.
What's the time frame for the loan? When you get expect to be paid off? I think we answered that one. Currently on horse, so a new investor to
Yeah. So if you're a current investor and you're asking about minimums or things like that, I would just say submit a soft commitment for what you're interested in doing. And again, the minimum is 100. However, again, there is some opportunity for those who can fund in the month of November. And so especially if you're a current investor with us and things, we would love to continue that relationship. So my recommendation would be put in a soft commitment form. We'll get you access to the data room if you don't have it already, and get on a call with you, and we'll figure out something that we can make work. But that's a great question. Will investors receive tax benefits with this fund? This is a fantastic question, and the answer to that question is yes. Actually, again, we're in 7 different opportunities. Some of those have tax benefits, meaning some of those are multifamily properties that have done a cost segregation study and are taking accelerated depreciation this year. So because we're in some of these opportunities, like actually equity investors as a preferred equity partner, we do get tax benefits from those deals. And so our best guess right now, we're actually getting cost segregation reports from those properties. Our best guess right now is somewhere around the 15% mark on the principal that you invest this year, meaning
in 2024.
In 2024, meaning if you invested, $1 million, there's $150,000 of
tax losses
that will be applied to that. So that is a big deal. It's not huge, but it definitely helps. So there are some tax benefits for this.
For a cash flowing investment, it's more focused on credit and debt. That's a pretty big deal and hard to find.
Can you turn off compounding midway? You can. Yep. Like I said, at any point, you can choose a compound, or you can choose to receive those distributions.
I see a question on the NAV. So curious to share how the NAV has grown over the timeline. Absolutely. I don't have it right in front of me right now, but if you reach out to our team, we would be happy to share the NAV increases. This fund, it's interesting. We have a full webinar that you can watch on this, but we've been doing these types of deals for a long time in our income fund, but we really saw a bigger opportunity, and that fund was pretty limited in what it could do because it started 11 years ago and had a very narrow focus. And so we actually pulled out all those deals. We didn't pull out those deals, but we started from that point on all these types of deals, doing it in this new fund called the Credit Fund. So this one we launched, and I believe it was April or May of this year. So it has a limited fund history, though Aspen Funds have been doing these types of deals for many, many years with a lot of case studies that you can review in our data room. But the NAV has increased every quarter, since inception. And one thing I want to make a point of too, and you read it in our documents, is that as managers, we only receive our profit share as long as what's called a high water mark is achieved. So as long as the fund NAV per share continues to increase. As managers, we've self-imposed that to basically say, if we're not increasing the net asset value of this fund, we're not going to get paid, right?
Yeah.
And we're going to force all those profits back to the LPs to bring that NAV per share back up to get back to the next highest point. And that's over a 12-month period, rolling 12-month period. We calculate that. So you have assurances, incentives are aligned, right? We want NAV to grow because that's how we continue to earn our profit share on the back end, and it aligns with investors knowing that we're putting in really good deals into the fund because we know that is going to directly impact the NAV. So great questions.
Here's another good question I think is really good to discuss on, because I think someone can, Chris asked a question, it's taken them a long time to get to this point. They've had it in the family for a long time. Does that bring up any red flags? I want to say something to that, but let me hear your thoughts first on why the heck are these guys moving so slow, and is that going to be an issue for us?
Yeah, well, there's a lot of things. One, this is multi-generational. So this is now the son that's kind of coming in and really kind of pushing it through to get it done. When they bought these, the idea was this is going to be a big family legacy play for them. And then they started doing some things, but then when 2008 happened, they put it on the back burner, right? Because there was a big meltdown. But they held on to it. They continued to kind of keep it going. And, really the past I think 3 years is when they've kind of re-engaged and saw the momentum changing in Lake of the Ozarks, right? With the increase of tourism, of the development going on, and saw the opportunity is ripe. And then the other piece is the entitlements, right? It's difficult, especially in an area like this where it's pretty well developed, to get things through fully entitled shovel ready. So kind of a combination of all those factors has brought it in. But again, you got to look at things from what's our position in it, and how do we benefit from maybe some challenges that they've had. Like, we're the net beneficiary in this whole thing.
Yeah, can I speak on that? Like, that's my whole point. Like, you're not, and I don't know your experience with the investor who asked that question, probably very experienced, but first, my point is, like, we're not a common equity investor.
Yeah, we don't rely
in some ways, like, who cares? Like, and I say that facetiously, but my point is, we are the lender, right? Like, we're charging them 16% annually on their loan.
Yeah. And to be clear, the appraised value is not once they build these homes. It'll be worth probably 5x what it's
current the appraised
as a value, just the lots, nothing else.
Right. And so I think that's a benefit. Yes, there is a part of our takeout, and maybe that's the pushback you could give. Part of our takeout is them moving quickly through the rest of this. But I do think it's important to note is, these guys have had this deal a long time, and I asked a very similar question. Well, that's a great point that the son is pushing this through, but it's very different in that we're not necessarily relying on them to finish the entire project for us to continue to earn the return that we pay investors for this. Now, our takeout is probably important to that completion, but we're going to continue to earn our interest.
They're also going to be selling most of these lots to other developers, right? So we're not relying on them to develop all these lots, which is a great point. But at the end of the day, it's like if we can feel good about the business plan, because here's my lens as an underwriter, right? I want to invest in this deal. I want to feel good enough to invest in this deal as if I was equity. And then I get to invest in it as debt, right? So I actually like this deal enough to where I potentially participate as equity with the right structure and the right, the right terms. But we get the best of all worlds here, and we're actually the senior lender with incredible interest. So
you said a lot, equity-like returns, debt-like risk is really the motto of this fund. That's kind of what we continue to go after. There's a lot of questions, and we don't have to go to all of these, but about the property, the family experience. Can you elaborate on the current or recent experience of the family that has the development experience?
Yeah, so again, it's multi-generational. So obviously, the older folks have been doing this for a while. We have a lot of other projects. I have a summary here. One of the sponsors, he manages over 500 properties in 6 different states, with and part of multiple real estate firms. A lot of it is in development. He's worked in multifamily, and his primary thing is going from raw land to entitlements and construction. So obviously there's some family members, but there are also some non-family members that have stakes in this project as well. And then one of the other gentlemen, who's one of our borrowers and guarantors, is a portfolio of more than 100 projects nationwide. He's also a successful business owner in Colorado, and manages a lot of projects from development through completion and development. So,
How long is the term on this loan? Do you have that?
2 years.
It's a 2-year term.
Yep.
And again, we have the option either to extend, or at that point, we
Yeah.
expect to be out.
Yeah.
But
And again, we kind of initially, as we're structuring these things, we do this a lot with a lot of these types of deals. We like to structure it on a short time frame to keep the pressure on, right? There's already kind of some natural pressure from the expense of the interest that they're being charged. But you kind of force them toward that kind of 2-year timeline, and then we can always reevaluate them. But we don't have to. If we don't
Right.
feel good with the project, we don't feel good with how they're operating it, with the progress that we would have hoped to see, we can, we can pursue other options and other paths. But that's generally not the goal. But we have that option, and especially in a position like this where you are the senior lender and you have a secured loan, you can afford to take some of those risks.
We got a few more minutes here, and guys, we're happy to continue to answer those questions. Sam, would you click off that real quick? Thank you, so we can see this. Let's just spend a few minutes talking about maybe some of the other stuff that's in here, so people can see kind of what they're. Again, we've talked a lot about Lake of the Ozarks, the seventh deal that is going into the fund. But it's important to know that's number 7. Like, we're diversified across a lot of things. So let's just maybe high level kind of talk through a couple of these.
Yeah.
Like,
It'll probably be less than 20% of the fund once it goes in. So again, this is important to understand these deals, but we do this kind of really more to help you understand the things that we're seeing. But then it's also one piece of lots of other really sweet deals that we love.
Yeah.
You get access to.
Let's just talk high level to a couple of these ones right here. This is a Lease Summit multifamily deal.
Yeah, so this is one, actually literally met with the sponsors last week. Great sponsors. They are vertically integrated with construction, property management. This property is literally in my backyard. I live in Lease Summit. And so we know this area very, very well. It's a developing part of town. Some of the sweet things on this deal, they were assuming a Fannie Mae loan at 2.9%, 94% interest, but it had very low LTV, right? Because it was originated several years ago. So their senior loan to value was 45%. So that means if we didn't come in, they would have to bring 55% equity to the deal. And one, that reduces returns quite a bit, but two, it's a big check for these types of sponsors that are really focused on the operational side of things and not on the capital raising side. So we come in and we're as preferred equity sitting behind Fannie Mae, right? So we do 3 different types of deals in this fund. One is what you just saw, the Lake of the Ozarks deal, senior secured bridge loans. We do second secured mezzanine loans, and then we also do preferred equity where we have a preference over common equity with certain takeover rights, control rights. So it acts very similarly to a lender position. You'll see here in a sec, but we're not secured by the underlying property. So in this situation, we wrote a $1 million check. This brought their LTV up to 55%. So still very low LTV all in. But it's, we have for sale rights as a preferred equity lender, which means if this borrower is not performing to our expectations and to the covenants that we've set forth in our governing documents, we can force them to sell the project and basically get paid out and basically gives us a big leverage stick. So it's not quite foreclosure on the property, but we have different tools, different rights and provisions that we put in every single deal that we can protect our position. This one we're earning 2% origination fee, 8% current pay, 6% on the back end, compounded monthly. It's a 3-year loan. Our takeout strategy refinance. So We expect them to achieve their business plan. And kind of the crazy thing in the Kansas City market, it's been on fire from a rent growth standpoint. They're actually achieving all their pro forma rents that they put forth in the pro forma without doing any renovations.
Wow.
So it's always a great thing when you can do that, right? So they have not actually having to put capex.
What is
capital.
what is the $1 million going towards? Then?
It's not going into anything in particular other than the whole project. So it's just capitalizing the whole project, which includes their capex budget, which includes the purchase.
Got it.
But we are in front of a 45% equity cushion. So I can't remember the exact dollar amount of equity, but it's.
Well, I think it's important to know, like you see, like combined
million.
LTV is 55%. On that loan. Here's another one right here. Combined LTV at 75%. And then look at this other one real quick, just so I can kind of look at all these 74%. So like that means with our money,
Yeah.
we're, our combined LTV is 75%, 74%, 55 on the other one. Why is that important for investors to know that that's an important number we look at when we're coming in?
Yeah, so we like to be under 75% as a preferred equity investor. And that, again, just gives us a 25% cushion above our position that the common equity investors would have to lose before we lose a dime, right? Yeah. So that's really, really important because the sponsors want to have generally a lot of skin in the game, and we're looking at that as a key component of underwriting. But two, they have reputational risk on the line if they lose capital. But ultimately, we can control the outcome of what happens. And so preferred equity, it's been around for a long time, but it's becoming more common, especially as we talk about in these other webinars where the capital availability has just been reduced from both the debt side, from traditional lenders, and also equity side. It's been harder to raise capital with a lot of the challenges going on in the commercial real estate space. And so we're kind of the beneficiaries coming in with helping solve that gap, but charging pretty nice rates of return for the risk that we're taking.
Yeah, Sam, if you would, please drop those links again, guys. If you're interested in this, like I said, there are some incentives we're offering in the month of November for investors who can act quickly, just because there's opportunity we're looking to fund this month.
We have a huge pipeline. So we talked about one Ozark deal. We have like 3 other ones that I'd love just as much that I want to get into fund too. So we're there's no shortage of deals right now, and especially at the end of the year where there's a lot of things happening. We're willing to be a little bit more.
So November is important. Also, if you can't reach November, if you're looking for tax benefits, that would be important to fund before the end of the year. So if you're not able to squeeze before the November the deadline, just know that you definitely want to get in before the end of the year if you're looking for some of those increased tax benefits we talked about. So Sam just dropped the link. Again, get access to our data room would be by submitting a soft commitment, just letting us know what you're interested in investing. And then you can also speak to an IR representative by that second link. That'll go straight to our calendar. And if you submit that today, just know you'll probably hear from our team here in the next 24 to 48 hours. I know we have a lot of calls right now on the calendar. So go ahead and do that. Want to make sure there's not any other questions while I look at that. If you want to, is this the third deal? Sorry. I love this slide right here.
Talk about it.
I love this slide right here. I mean, it's just like, again, I've been saying this a lot, like as an alternative investor and knowing, personally what I've invested in over the last several years, it's just, I like the Aspen Private Credit Fund. I really, really do. It's, you're getting the monthly cash flow, there's very little deals right now that are offering, strong monthly returns backed by real estate. And the way we're able to do that is because the way we've positioned this, right? Because we're in a debt-like, we're in debt-like positions. In most of these cases, we're able to manufacture cash flow. Distributions in 90 days or less. And in this case, probably shorter. You can reinvest your dividends. Yep. I mean, how many real estate funds are out there that actually give you the option to compound, right? And not only the option to, is like an on-off switch is what I keep saying. Profit sharing we're offering is, I think this is cool. It's not just debt, but it's also profit sharing because we're creating upside in these deals. So you're not just getting a flat 9%. No, we just said we're almost at 12% cash yield just for this year. So, you're getting to share in the upside. Aspen Funds has been managing managing funds for over 11 years. And I think that's important is like, what makes us unique. I think that was cool to hear Bob talk about that, in this world of private credit, there aren't many lenders sub 10 million.
Exactly.
Which makes our deal flow really strong because they're groups like this that aren't these big shops that they don't need $15 million.
No.
They need $3 to $4 to $8 million.
Yep.
And that's how we're able to kind of come in and carve out our spot.
Yep.
And guys, private credit is not going away. I mean, just look at BlackRock. BlackRock says this will be what they say, a 2.3, maybe a $3 or $4 trillion asset class in 2028. That's 3 years from now.
Yep. Yeah. No, it's not going away. It's been around for a long time, but the trajectory of it is just continuing to rocket ship up because of the need for capital in the space. And there's just, consolidation of banks and more regulations is making them less willing to take, certain deals. Yep. Equity is harder to come by, especially as we're kind of going through this turbulent market. So opportunities now, this is not going away. And you're exactly right. We have kind of I'd say a really unique part of the market that not well served
for us.
We have a great niche that we can scale up into for a long time.
Yeah.
But we have a couple of questions that came in that I think are good just to hit on real quick about tax benefits, depreciation. So the tax benefits, because in this fund, several of our investments are as preferred equity, we actually are written into the operating agreement and will be allocated depreciation for the 2024 calendar year. And so we have talked with the individual operators of those deals and gotten the cost segregation studies and are estimating what that flow through to the individual investors like you would be for 2024. And so when we're saying 15%, so if you invest $1 million, you get $150,000 of passive tax losses that you can use against other passive income, or if you're a real estate professional, against active income. So again, we're not CPAs. Go talk to a CPA. Make sure you understand that you can use these losses being passed through. Again, they're passive investment losses. And then depreciation, we're not adjusting the numbers that we're sharing with you by a made-up depreciation number.
That's a good point.
It's great point.
It's a bonus.
I've seen people do that. So the depreciation is on top of what you're already seeing there.
No, I'm talking about money in your hand is what the only numbers I've talked about. Like what current investors are getting in their bank accounts.
Yeah.
As of, we just sent a distribution out on Friday, I think. So every month investors are getting distributions. That's 6% plus the profit sharing. So, again, I think last quarter it was just over 11%, 11 and a quarter. So that's what investors are currently getting.
Dave, great question. I said 150. So it's 15%. So if you invest $100,000, that would scale down to $15,000.
Oh, 100,000 be 15,000. Yeah. And that would come on that would be shown on your K1.
In 2024, K1.
Yeah. So you go to K1 for 2024 and 2025, and that's how that would be applied. So guys, we're going to wrap up here. I just want to summarize. Sam, if you would drop that link one more time, just put it on top of everybody's chat. We are going to send the replay out. We'll make sure we get this deck updated in the deal room. If you don't have access to the deal room, submit a soft commitment form. That's how we'll get you access to the deal room. Again, inside of the deal room, Ben did a walkthrough of every single deal that we have currently in the fund. If you want to go do due diligence on this fund and the other assets we have, you're welcome to go do that. We'll do that again this quarter. So you see exactly how those deals are performing. We'll do that every single quarter. Okay, so you have transparency ongoing. A lot of folks have asked about UBIT. There is currently no leverage in this fund, although we do reserve the right to potentially put a small amount of leverage in this in the future. However, you would, of course, be informed on that. So there's no UBIT at the moment.
There won't be in 2024.
A great opportunity for self-directed IRAs, Roths as well. So here it is, 6% preferred return. Okay, we do a 70% profit split, which that is going to come out right now at about 11 to 14% target compounded returns annually. The minimum investment is $100,000 for this. I know a lot of you here are looking for reinvestments. We're definitely willing to work below with you on that if you're looking for a reinvestment. However, the start in this is $100,000.
Or adding your position is what reinvestment
adding your position, is what I mean. It's a low 2-year lockup period, meaning you cannot do a liquidity. You cannot pull your money out up until the 2-year mark. However, after the 2-year mark, all you have to do is give us a 90-day notice, and it essentially becomes a liquid investment for you at that time. And then you have the option for monthly distributions, or you can reinvest for true compounding growth, meaning that your distributions just go buy more shares in the fund. All right. We covered a lot here.
Great stuff, guys.
Do investors get a share of the origination fee and the exit fee? Yeah, I mean, that's part of the, it's money to the fund, right?
Yep.
I mean, that's how we're earning these returns.
Yeah, so all the income we generate, whether it's origination fees, exit fees, interest, accrual, that all goes into the fund profit, and then it runs through that waterfall that Ellis just talked about, where investors are prioritized.
Yeah. Guys, we'd love to speak with you. As the Vice President of Capital here, we really do want to continue to build long-term relationships. What I love about Aspen, I can speak this as someone who's fairly new to the company. Whenever I look, I'm about to call an investor, I'll go look at their positions. It's amazing how many people have 3, 4, 5, maybe even 6 investments with us. And I think that says a lot about this firm, right? Is that we continue to provide a great experience and provide consistent, conservative deals that people want to continue to invest with us. And so anyways, I'll say that to say we really would love to get on the phone with you. If we have not, if you're a new investor, please schedule a call with us. We're here in Overland Park. My whole investor relations team, I'm looking at them right there. They're on the phone with people right now. We would love to chat with you. Okay, seriously, we'd love to build a relationship with you and here, not just for this. I don't know if you know this, but if you're new to Aspen Funds, we have things like oil and gas. We have things like industrial, new development. We have things like debt. We have a debt fund that's been paying for 11 years. We've never missed a distribution in our debt fund in over a decade. We just, we had another growth fund. I mean, what am I missing here? We've done some multifamily. Yep. So we have other things that could potentially be a benefit for you. But again, we'd like to schedule a call with you and really get to know what's on the horizon for you for 2025. And my team can really help map that out for you and really understand what you're looking for. And then we can kind of help prioritize what would be a good fit for you and your portfolio. So please schedule a call with us. We'd love to meet you. Guys, thank you so much. Don't hesitate to reach out to us. Thanks for everyone for joining. And thank you so much. I see some referrals here.
Thanks,
we have
Wes.
1.5 million with Aspen, and we love investing with you. Thanks. We're looking forward to doing more business. Thanks, everyone. Have a great Monday, and we look forward to chatting with you more. Cheers.
See ya.